guys, Jack from MajorLeagueTrading.com, and I'm going to be going over a trade review. I've had a lot of requests from both my trade room members, Nadex course members, to review some of the trades I've taken to help you guys better understand what I'm thinking about when I'm taking these trades. So I'd like to go ahead and talk about a couple of trades here I have on and talk about the risk with every single one of those trades, what they were paying, etc. So let's go into that. Going to bring a calculator into this screen view to so we can do some calculations, some basic calculations here. Not that they're sophisticated, but I think it'll help. Let me see if I can zoom in on this so you guys can see this a little bigger. All right. So I have sold my two bigger trades here. It's a pretty concentrated position, but I'm short about 200 contracts. So the total value of these contracts is $100 a piece. So that means if I've sold 100 and I'm correct on the trade, at the end of the day, I will get $10,000 back into my account minus an expiration fee of $1 per contract. So on a 100 lot, that means $9,900. Now there's two different trades here. One is more aggressive than the other. The average price, because I'm short, okay, when I sell for 82, if I'm short, so it says minus 100, if my average price is 82, it's actually 100, look at my calculator, minus 82 equals 18. So that actually means it only costs me $18 per contract, not including commissions, which is $1, so call it 19 bucks. When I sell those contracts for $18 and they have the possibility of going to 100, that's roughly a 400% return. Okay, so I'm quadrupling my risk. I'm putting in, say, $20 of risk. I'm getting back $80 of profit. Now, that was the more aggressive trade here. Anytime you're risking 20 to make 80, that means that the probability of that happening should typically be lower. Now, my other trade I have here for the US 500, which is the S&P 500, that strike is 50 1/4, which means it costs $49.75. Okay, multiply that by 100 and we got $4,975. So I'm risking, in this case, I'm risking $5,000 to pretty much make $5,000. In this case, I'm risking $2,000 to make $8,000. Obviously, you'd rather be making $2,000 off $8,000 or $8,000 off $2,000 than $5,000 off $5,000. But this is where I'm going to get into the analysis of the trade, and I want to show you and talk about what exactly it was I was looking for. And I'm going to go to an hourly chart here in the S&P 500. We are well below my strike levels at this point in time. I have two different strikes, and I'm going to mark those up. So I have the 2672 strike, which is right here, 2672. And then I have the 2660. Now, I actually got in both of these trades. I'm going to go to a smaller time frame. I got in both of these trades when we were right around the 2672. So on this consolidation, this 2672, I sold an at the money strike, which is that 2672, and then I sold a strike close to the prior day's lows. My anticipation was that, did I think we could get all the way down here? Yes. Was that initially what I was hoping for? Obviously, but what I saw was a series. We had a lower low and a lower high on Thursday of last week. Then Friday was followed with a lower low and a lower high. Then on Monday, we had a lower low and a lower high. Okay, so we have 3 consecutive days with lower lows and lower highs. We've run all the way up into what I have. It's called it's a setup from my Nadex Master Course as well as my Fibonacci course. This is called a halfway back short. So what we actually have is traders getting caught long in the overnight session. It's a low volume session, Asian session, European session. Those traders don't necessarily matter. We can completely reverse. So we have heavy volume sessions during the New York time. The New York time, we go lower low, lower high, lower low, lower high, lower low, lower high. But then we all of a sudden put in a higher high. In the overnight session, we get above the prior day's high. It's actually a high of the week because this is Sunday and Monday. And then as soon as the market opens, I realize and believe and come to the assumption that we're probably going to take out and make a lower low. And so I looked at that strike at 26.60 and it cost me 18 bucks to get in. I'm like, 18 bucks, boom. I'm gonna make 82 if I get this trade right. That is a fantastic risk to reward scenario. But then I said, okay, well, if we get to that lows, maybe if we get to that low, you can take that Nadex contract off and you can sell it automatically. So if I wanted to, I could have exited that trade immediately. Okay, I could have exited that trade immediately for 50 bucks and it still would have been 200%, or 60 bucks and it would have been 200%. So the other trade I took, the 26.72, I thought, you know, maybe we're not going to break down 35 points. In your head, you can never be sure we're going to break down 35 points. That's pretty hard. Everything's probability. I thought that our probability of dropping below the prior day's low was relatively high compared to the risk in the percentage gain I would gain if that did happen. We are really truly beyond what I thought we would do, but that's going to happen in trading. You know, you're going to be right and get paid, and that's part of it. So what you want to be aware of is if you are going to go for a further out of the money strike, I typically like to finance it or take a more higher probability trade, and that is this 26.72. That was the higher probability trade here. The reason it's a higher probability trade is because it was at the money. So technically you have around a 50% chance of being right, not including the spread. So there's always like a $4 or $5 spread, which is technically the market maker's edge. So I had a pretty good chance, or say call it a 50-50, not knowing any technical analysis. It's a coin flip, right? And so with that, I said, well, if I'm right on this trade and wrong on this trade, I'm still going to make $3,000 actually, because I risked $5,000 here to make $5,000. I risked $2,000 here to make $8,000. Now, if I hit both, I make 13 grand. If I hit one, I would have made 3. And if I hit neither, I would have lost 7. So realistically, it plays out. The whole trade is structured as a risk 1 to make 2. But there's, you know, you can take the trade off at any point in time, cut losses, etc. That's just upon a binary expiration, which is either 0 or 100. So those are the 2 trades I have here for the US 500. Now I also have a trade here for the USD CAD where I had risked $38.50 a contract. So 38.50, 38.50 multiplied by 50. So my contract size isn't as big. Still about a $2,000 risk, which is what I typically like to risk per trade unless I'm feeling real good about it. So about $2,000 of risk on that trade here in the USD CAD. And let's take a look at that chart and I'll show you guys what I'm looking for. So my expiration for this USD CAD right now is above 128.40. We're below that. It's not looking as good as the other trade right now, but I do have some time. My support level this morning and what I took this trade off of was this gray box. It was part of my morning trade plan in my trade room. Now this is right around the previous high, but this is a setup from my Fibonacci class that I use, and you can learn that. I'll put a link below. And by the way, guys, there's a couple things I have in here. The indicator at the bottom of my screen is called the pinch. I'll leave a link for that below if you want to get that. And then I'll leave a link below for my Nadex course and my Fibonacci course. All of those courses are going to be extremely helpful for you to developing technical analysis, picking markets, understanding strength of trend. You know, there's a couple of different puzzle pieces to put together, but that's really all of the information you need on this. So with this specific trade, I risked $38.50 for the USD CAD. My total risk is $2,000. My max reward is going to be slightly over 3 grand. So if we do end up getting up there by the end of expiration, I will make $3,000. If we don't, I will lose $2,000. So I'm risking 2 to make 3. It is a positive risk to reward scenario, and the reason I'm getting $3,000 for every $2,000 of risk, or $3 of reward for every $2 of risk, is because I was betting for an out of the money occurrence. So I still need to move above. I have till 7 p.m. tonight for that to happen, or I can just take the loss right now. So that is what that trade looks like. And you know, you guys, just a part of trading, you're gonna have losers. I got one on right now. you're going to have winners. And it's important to make sure that your winners are, number one, more frequent than your losers, and that your losers are smaller than your winners. That's like the biggest thing in trading. And also, guys, do not look at the size that I'm trading and be like, I want to get to that level. I'm going to trade super aggressively. It has taken me years to get to the size and consistency I am at. It's going to take you the same. You know, you don't need to make $10,000 in a day. And there was years and years and years I went by before I even had a day of seven figures, 4-figure day. So 4 and 5 figure days, you know, do not be going for those. Be consistent, trade small, guys. It's much, much important to trade small. There's an entire risk lesson in my Nadex Master Course. I recommend you go through it thoroughly. Study, 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 and subscribe to my YouTube. Please like this video and feel free to comment below if you want to see more content, and let me know what you guys want to see. But that'll do it for this trade review. Everybody take care, and I hope you enjoyed it.